Austin Harbour from Piper Sandler and Sean Ebert from Altera. This is going to be an interesting discussion here. Both of these are interesting characters with very rich perspectives that I have known for a few years. So please have a seat and we can... do either of you have slides? I don't think so, right?
No, sir. Or I don't.
No slides.
No slides. Perfect.
Unusual for a former consultant.
Yeah, and a banker. Nobody got that on the bingo.
I know, yeah. A banker and a consultant, neither of us showed up with slides. What's going on?
So, we've been having the ADI forum for many years, and while we've done a lot of work in oilfield services and equipment, we've never had a panel because there's never enough time, right? By the time you get through the oil and gas value chain, you don't have enough time. But now that we have added another day focused on energy transition, we finally get to have a panel focused on oilfield services and equipment. So we obviously have agreed on a bunch of stuff, but I'm hoping it's okay if we diverge a little bit, and we diverged right on the bat. So the last panel we were wrapping up, and Carol raised some interesting questions on the value proposition of digital in and around oil and gas and all that. So Sean, we'll kind of start with you to kind of just close the loop there a little bit. You've been a very successful investor in and around digital, especially as it comes to upstream oil and gas, and a lot of it really focused on creating value for onshore shale operators in recent years. So can you talk a little bit about what does it take to first make digital successful in upstream oil and gas, and I guess what are some learnings that you have picked up over the years?
A lot in that question. I think you started with the value question, which was part of the last panel, and I think in upstream oil and gas, that's very difficult to quantify. Oftentimes, it's systems of systems. You have so many different dimensions, different decisions being made, and oftentimes we've struggled to actually put a dollar amount to that. One particular challenge was microseismic back in the day when we exited that. What's that incremental value? I think with some companies you have folks like ResFrac where they can sort of shift MPVs and put value to it, and then we have digital companies that sort of have a center of gravity in oil and gas, but then quickly sort of matriculate beyond that. Thinking of a company like Seek. And they've got to the point where they have got so much data that they now have an engine basically available to their customers where they can do a lot of modeling of what's that value to be unlocked by deploying that software. Success factors, that's another part of your question. And that's a very interesting question, because one thing we see as being venture capital investors in this space for multiple decades is there's so many sort of oil and gas upstream focused software companies that end up kind of stuck in sort of a revenue range, which I know we've talked about before, and how do you break out of that? And I think it's very difficult. I think if you look at the software landscape right now, how many companies are really doing that? I think it's a very small number. And so what we've done and what we've liked to do is to invest in software companies that have a center of gravity in oil and gas and can take a lot of those learnings, a lot of those capabilities to other sectors.
Okay. Austin, you've seen a lot of transactions and probably quite a few in and around digital and software as it relates to OFSE. A lot of the large OFSE majors are also have very strong software digital portfolios. Thoughts on what you are seeing from that perspective lens?
Yeah, I think it's interesting. I think a lot of the OFS players are still trying to figure out exactly how they marry the value proposition of a digital platform and a software platform with a business model that actually works. So in a former life, I worked on, for instance, the Baker Hughes C3 AI JV, and it is funny looking back on that. What the value proposition from Baker was hey, if we can get a revenue multiple on any of our businesses, that's better than how service and equipment companies trade. So how can we go wrong? I think if you go back to first principles, does this really fit with Predix? Does this really fit with C3 AI and the suite of applications that they enable you to develop on a bespoke basis? I mean, maybe not. And I think I don't mean to pick on them. I thought the deal made a lot of sense from a financial engineering perspective. But I think companies are still trying to figure it out. A place a lot of my clients have been spending more time in is how can we take this idea around methane capture, emissions monitoring, emissions management, and not just build a profitable business around mitigating methane, but also being the data analytics piece that can tell the software, tell the ERP, speak to the ERP, and speak to the clients around it and say, this is accurately measured. This is how the performance is based, but this can also feed directly into your financial statements. And on top of that, we provide the service that actually creates, fewer methane emissions, and we have the toolkit and the piece of equipment that does that. But I think writ large, still trying to figure it out. Halliburton's another interesting case study with what they've done, basically starting an internal VC organization and in a way saying, maybe we're not the experts at coming up with all of these things in-house, but we also recognize that we can't just turn a blind eye and say everything's not going to work if it wasn't made here. There's a lot of if it wasn't here, it's not, legitimate. And I kind of applaud that approach to it of saying, we'll partner with you, we'll help incubate, we'll take a stake, and then we'll help expose you to a broader network to help make you be more successful. I think the early returns have been good. It's really early in that journey for them, but just circling back to my original point, I think they're trying to figure it out still. Yeah. I mean, historically, service and equipment companies haven't been that good at harnessing a software, a technology, and then really bringing that to fruition the way technology and software companies typically do.
And I give kudos to Halliburton as well, and what Scott Gale and folks are doing with Halliburton Labs, because historically they've sort of been emerging tech company repellent in many ways. They're kind of shock and awe, they're scary, they're IP bullies, etc. And so I think the move that Halliburton made, is a really strategic attempt to kind of change that.
Yeah.
Because the reputation for how they've worked with emerging tech companies is terrible.
Yeah. Yep.
Is it harder to insert digital in existing operations, like say artificial lift or completions, and a little bit easier when it's a brand new problem like methane emissions?
Good question. I mean, you already have software and digital in those different spaces. To get, folks to change is difficult. I think drilling is sort of the archetype for difficult to change sort of business unit within an oil and gas company. But I think if we look across the decades, there's that one McKinsey study that everybody references from, but now I guess 25 years ago, on how slow oil and gas has been to adopt things.
Must be wrong.
Yes. I think with the rise of the independents and how they've adopted technology, how they've became to be who they are today, I think they're more willing to do that, I think, across most of the business units. I actually think that the software conundrum for oilfield service companies is an interesting one, because some of the operators now are just no more dashboards, please. Just give us the data, and we're going to analyze it and assess it ourselves.
Yeah, I agree. It's a great question, and that it's relatively ubiquitous when you start thinking about production optimization, right? Like if you go back to, Weatherford's had the Signet business, and the idea behind that initially was, we're going to marry this with artificial lift, and we're going to be able to dominate that in disparate areas where you can't send a guy in a truck out there all the time, because that means that well's not economic anymore, right? So I think some of these concepts have been around for a really long time. Is it easier on newer technologies? I think that's a very idiosyncratic question. I think that the trick for service companies is not to give away the biggest value driving piece, whether it's the software, the algorithms, or the actual kit and equipment that makes the operation more efficient, i.e. more economic for the operator. What service companies have historically been bad at is providing a solution and then not deriving requisite economic rent off the highest and best use of the value proposition that they're delivering. I think drilling's a great example, and by that I mean day rates for drilling rigs, and then adding in the directional and adding in parts and pieces of the BHA and adding in the drill bit, and just kind of working yourself out of a job because you're day rate based, but you're also efficiency based to be able to earn the right to earn the day rate. And I think those models are slowly starting to shift and evolve. But certainly, to introduce that software and technology, if that's the big enabler, the trick is for service companies to demonstrate that to operators and then harvest that economic rent.
If you figure that out, let me know, because we'll cascade that down to our portfolio company.
Well, it was a big part. So we sold Ulterra to Patterson, and it was a big part of the thesis there because of the platform and the technology and the access to data. Sean's point earlier, the access to the data and the level of data that Ulterra had to be able to optimize that ROP and optimize how you land it and optimize how you drill through it, particularly in a world where you'll see increasing unconventional activity in the Middle East. There's a lot of value to that. Now, again, the trick is how do you put that entire package together and monetize it?
Yeah.
Excellent. So now we are closing on that digital loop. I'm going to show a couple slides that leverage some of our work, if this works here, and then we can get back to the conversation that we were having, right? And Austin, some of this will be familiar, but we are obviously seeing a pretty significant shift in adoption of ESP, right? I mean, as shale is maturing, right? We didn't get into this conversation, but we had another conversation with some operating staff at Callan, and they are talking about how in some of their newer wells, they are deploying an ESP right off the bat, right, as soon as they drill it, because they don't want to go and incur the cost of a workover to then deploy a ESP later, right? If you look at the revenues of some of these artificial lift-focused companies, right, they're all doing well, right? Lots of them are selling ESPs. ESPs have their own problems, and life is an issue, but we are seeing a lot of that. And then finally, we are finally seeing some innovation kind of come into the ESP artificial lift space. It's occurring at a slow pace, right? We've been doing a lot of work in production chemicals over the last 10 years, right? And we've created a version of this over the years. And 10 years back, if you looked at a version of this, there'd be very little orange, right? And you'd only see the use of production chemicals where there was an absolute critical need. The casing was melting, and then they would be like, okay, let's think about some corrosion inhibitors, right? I mean, it's probably an exaggeration, but kind of still now it's a lot more sophisticated, and across the place, right, you see different operators using these production chemicals in a lot more thoughtful fashion. When we look at the operating data and we break it down into real granular segments and line items, right, and you look at what is the spend on production chemicals, what we are seeing is like best-in-class players will now spend a pretty significant chunk, 20-25% of their total operating OPEX on a per barrel basis on production chemicals, right? So they're getting to the point where they have, through trial and error, figured out that, okay, we've got to spend on some of these things in order to have a better operating life out of these assets. The shift around ESG, we are seeing increasing interest in different plays around low carbon, clean power. This could come in the form of solar, renewable. Brent Williams from Callan, I think, was talking about this in the morning. But we see interesting battery technologies. We see interesting energy storage technologies. Some of this is experience that you probably want to forget for some of your portfolio companies, Sean. But they are doing well now in different areas. But we're kind of seeing some interesting technologies being used in different plays around low carbon power. And then finally, of course, energy transition. Rohan talked a little bit about ResFrac getting involved with, but we are seeing a lot of service companies kind of partner with early stage geothermal energy technology providers, right? So lots happening in and around OFS that we see from the lens of our projects and our work. But if you were to reset a little bit and think about OFSE in a broad sense, Austin, where do you see the most, like what are the hot spots in OFSE today?
Yeah, well, relative to years past, it's becoming more and more ubiquitous. So I would tell you since about last August, so August of 23, and just to do a little stage setting, you'd seen rig count come off about 15 to 20% in lower 48. You've seen frac count and completion stages come off about 25-ish% over that year-to-date period. And I think common thinking around Wall Street was that, well, as a result, right, all these companies are going to nosedive again. Nobody's going to generate free cash. They've probably overbuilt already in this short little 18-month post-COVID cycle we've had. And here we are again, like on the seesaw or the roller coaster. And what was interesting to me was that while companies came out and said, hey, we're going to need to lower EBITDA estimates, top line and EBITDA estimates, we're effectively reiterating what our CapEx plan was for the year. And as a result of the lack of overcapacity and discipline and new business models that are focused on returns instead of growth, you saw all these companies come out and say, hey, we're going to be able to pay a dividend. We're going to generate real free cash flow, not only this year, but next year, and in an environment that's flattish. And we have a sustainable, investable platform for you now. So since that occurred on kind of Q2 earnings calls and giving Q3 guidance, right, we've seen the narrative play out that lower 48's flat to down. In 23, we've seen the seasonal slowdown in Q4 that's become more commonplace in this post-COVID world where budget exhaustion is real for operators. And yet we've seen equities on a relative basis kind of hang in there. And in some cases, like compression is an excellent example, we've seen multiples inflect materially to what they would have been mid and late cycle prior to COVID. What that tells you is there's a little bit of capital coming back. So I don't think it's a floodgate of capital yet, but I've had 15 to 20 conversations with generalist private equity funds or energy-focused private equity funds that had told us, like, never again, ESG only, renewables only, who are now calling us and saying, not we just want to see your natural gas or your new energy or your new technology deal flow, but they want to see all of our deal flow because to them right now, energy offers the best risk reward and relative free cash flow yield versus all of the other sectors out there. And some of the entry points for these businesses are 2, 3, 4 times. And you just can't find that anywhere else in the market right now. So I would tell you, writ large, OFS is starting to become a lot more interesting. I'm spending a ton of time on the production side of the house. In the lower 48, the view is that our world is mature, and therefore the most economic barrel is the marginal barrel of production. And so that chart you showed with the LOE and the components of the LOE, I think service providers as well as operators are laser focused on that because we know it's there and we know we're only getting 6 to 8%. And we need to eke out more of the existing wellbores we have. On the unconventional side, on drilling and completion, we're focusing a lot across the board, all the way from capital intensive to non-capital intensive businesses that have real applications. On the front end in particular, as this movement in the Middle East and particularly Saudi Arabia is to drill and complete and produce more unconventional wells, and they don't really have the technology internally to be able to do that. So spending a lot of time talking about that. And then the last one I would say is the varying degrees of where the Venn diagram overlap from traditional oilfield services and equipment to is there some kind of cleaning and greening narrative? I mean, primarily, electrification, running off or utilizing natural gas, methane or emissions abatement. To the extent you have kind of what we would think of as a traditional service and equipment business that does that and makes money and generates a real free cash flow return, and there is a cleaning and greening story that's more than arm waving but very legitimate around that, investors are very laser focused on that because it's enough where they can get it through their investment committee, but it's also something that they know and they've owned before and they understand well. So sorry for the long-winded answer.
That's good.
But
that's a very good view.
It's pretty broad-based right now, Sean.
Yeah, and I think, and correct me if I'm wrong, I think some of the sort of more direct sort of diversification plays that, hey, we do this work offshore, we can go work on offshore wind, that really never materialized. And I've seen arguments even from operators of renewable energy assets. They don't want the touch point of an OFSE, given that they do work in fossil fuels, and I just haven't seen that happen. I don't know.
I mean, we've worked on a few deals like that, and we get a question a lot. If you think about the ENCs or the MMO guys, or the MRO guys, so maintenance, repair, and operations, like a lot of what you do in a refinery, and particularly when you do it to the standard you have to do it to, is perfectly applicable to what you would need to do to an offshore wind farm, just from the standpoint of just a level of accuracy and the workmanship and the craftsmanship that goes into it. We've seen some of those investments occur. We've seen some companies step out into those other markets. I would say just as often as not, they've stepped out into those markets so they can say that they're in them, but they don't generate, it's been dilutive to margins and returns.
Got it.
Right? So the advice we give when we get asked, like, how much exposure do we need to renewables before we get credit for it in a deal? And my answer is, well, if it's legitimately accretive or at least break even with your current margin and free cash flow profile, and you can show growth and a real business case around it, I think almost anything is valuable and can get you some at least incremental value in a transaction. But if you're just going out there and getting access to it, but it's dilutive, or you don't really even know how much you're going to make or what the addressable market is or how you're really going to attack it, you're more likely than not to wind up with less, all-in value, because people will perceive that it was just a little bit of a marketing gimmick and a little bit of a tail wagging the dog from a strategy perspective, right? Like nobody wants to be BP, right? I mean, right? We've seen how that played out. Now they have an activist telling them they never should have done that. And I would have told them that for free, but they didn't. They didn't call Austin Harbor before they made that decision.
So I'm going to flip that question a little bit for you, Sean, right? I mean, you have a lot of onshore operating companies as your sponsors and partners and limited partners and so on and so forth, general partners, right? So I'm curious, what are they telling you in terms of what are their pressing needs that could become interesting opportunities for OFSEs to attack, or become interesting, you'd hope they'd become interesting startups that you can invest in, and then the OFSEs acquire them, right? So, are there big needs and pain points from an innovation point of view that you're hearing from your sponsors and partners?
Well, the two big ones are, I think, already discussed. It's electrification and methane. Everything around methane management. I think with electrification, obviously, it's compressors, it's fracking, it's going that route to the extent you can. I think with methane, I think everybody recognizes the problem and the opportunity, but from a venture investor, we just see such incredible fragmentation in the different types of technologies. There's regulatory uncertainty, and I think we're in one of those phases now where it feels like if you just wait a month, you're going to see the next new interesting methane sensor or quantification algorithm, et cetera. So very much storming, forming, and norming without, at least from our vantage point, a clear winner emerging. And yes, we have 7 oil and gas companies as our LP based, and we obviously stay very plugged into them, and they're basically piloting and trying everything right now. And so that's kind of the scope, I think, that our operating partners are focused on.
So Austin, when you look at the big OFSEs, Halliburton, Schlumberger, SLB, Weatherford, right, Baker Hughes, from an innovation point of view, are they focusing on, I guess, segments beyond, methane emissions or beyond, some of these sustainability aspects? Like, are there innovation needs and pain points in traditional drilling, completions, artificial lift production services that are resonating with the existing base of producers?
Yeah, I think they all have a little bit of a unique approach, somewhat guided by the hand that they're at the table playing currently, right? Like they have the cards they have. I would say the How Labs is really interesting because their mandate is extremely broad. Like, I would highly recommend to everybody to go to one of their I'm going to call it an investor day, but one of their show and tell days where you get to hear the pitch and interact with the companies, and some of them they invest in and some of them they don't. But it's fascinating how broad based, and I would also say just how innovative some of the ideas are. So from an innovation standpoint, that's a big focus for them. Another piece is, look, like Halliburton's the biggest frac company in the world, right? And a huge piece of the future for frac companies is how do you power it, right? Because you have this huge draw on electricity or power up front, and then you have a much smaller draw that needs to be really steady. And it doesn't really lend itself that well to grid applications, like for those reasons. We've spent a lot of time with some of the bigger players, both thinking through what's the strategy on how you power all of this equipment at the pad in these disparate areas. How do you do it from a logistics standpoint? And how do you do it like economically, right? Because we know that we need to power these things and we know we need to do it well, but we also have to do it just in time, right? In a place where the grid doesn't exist. I would say there's a lot of focus in and around that for Baker. I think they're really obvious about what their strategy is. They almost have a two-pronged strategy. There's an oilfield service and equipment strategy, and then there's the strategy around the LNG business, and then I think new energies. And I think they've piled, I would say, relatively hard into hydrogen. And then obviously they have the rotating equipment on the turbo machinery side, which puts them really in a completely different class from everyone else, and gives them a story that is real and relevant and massive. And then Slum's a little bit of a head scratcher. For me, I think they're still trying to figure out exactly what direction they go. I think it would be really, really hard to be a service and equipment company that was, founded by the gentleman that came up with so many of what reservoir characterization is on the technology side, and then to be headquartered in Europe, right? I mean, that's a really challenging place to sit right now, and there are a lot of factors that play into that. And then Weatherford's been really interesting to me. They've done an excellent job. I worked on the restructuring when Mark McCollum was there, and helped bring that company out of Chapter 11. And I really thought that they would reorganize pretty heavily around wellbore construction and around artificial lift, and try to update and upgrade kind of that SCADA system. And I think what Girish and his team have done has been just nothing short of remarkable. Where they started was first principles, which it sounds obvious when you do it, but no one else had, which is, hey, where are we making money and where do we have our best strengths? And then we need to pair and purge where we don't. And I think they have just continued to reinvest in what their core DNA is as an organization, which is like new technologies that generate really good returns, and they've performed extremely well.
So, Sean, if we go back 12, 13 years, there was this piece of work that we did for you where we looked at all the acquisitions that the big OFSEs were making, right? As that in some ways was the discussion on exit strategies for investments in early stage oil fields. It seems like that's not happening a lot these days, or we are not paying enough attention to that.
It's not happening. I think there's a perspective that that the OFSCs, because they've sort of underinvested in technology a bit over the past couple decades for a variety of reasons, that there will be a wave coming up. We haven't seen that. I think if you look at our funds past, OFSC was kind of the default exit option for our portfolio, but that's no longer the case.
Yeah.
When I look at our portfolio right now, we maybe only have one company in that portfolio that would be, I think, an OFSC acquisition candidate. So that the market's changed a lot, and I mean, as you mentioned earlier, we like those different acquirers as well because we like revenue multiples, not single-digit EBITDA multiples.
Yeah.
So given that, what are the OFSCs buying, if they are buying anything at all, Austin?
Yeah, so look, we just sold an ESP platform to NOV, Extract, and if you just think about the artificial lift side, right? Like there was a big M&A wave there. I mean, I worked on the Apergy Champion deal that created Champion X. There have been a number of acquisitions that Schlumberger has done to build out their portfolio. A number of deals that GE did to try to build out a portfolio. We sold Summit to Halliburton over the years because they needed a big ESP platform. And now when we look across the landscape, a lot of the bigger pieces in the puzzle are relatively filled. Like if you think about ESP, gas lift, et cetera. I think where people are now focusing maybe a little bit more is on that accessory side and on the enablement side, right? So all the parts and pieces that actually enable the ESP to do what it does. I think too, look, they're thinking long and hard about how to play this, I'll just call it power generation in general, right? It's a bigger issue than maybe most realize. We've done some work on the CNG side. We sold Siren to Liberty, for instance. And one of the reasons for that is, you know, when you go out and bid a frac job now, I mean, you have to put a number down for what your diesel displacement is going to be. And there are some field gas processing solutions that exist out there that are in kind of various stages of development with various capacities. But the reality is, again, like it's a just-in-time problem, and it's a lot of joules of energy ultimately that you need to be able to manufacture to power this stuff. And you need to be able to do it consistently 24/7. And the power company can't be the guys that flip the switch and stop work. So a lot of the bigger guys are spending time, you know, thinking through that and thinking through how does that impact them. And then on this in the lower 48, the production side is very prevalent. Internationally, and particularly in the Middle East, it's how do you build service organizations that can be a lot of what they are to bigger players in the lower 48 in the Middle East, right? And that's kind of easier said than done. I don't know if it's going to necessarily be like the offshore market is with bigger contracts and big bonds posted and things like that. I think what the Middle East wants is they want to be best in class at wellbore construction, which they're not today, and they want to be able to understand their reservoirs onshore as well as we do now in the lower 48. And so there's a ton of opportunity for even plug and perf wireline companies, frac companies, anything up and down the chain on wellbore construction. And that's interesting to a lot of the big four because they're trying to figure out how they right size and I think tailor their portfolio over there to exactly what Aramco and some of the other bigger operators want and need.
You know, and then, you know, from our vantage point too, I mean, the market really needs more exits in sort of the energy tech space as well. And an example I forgot to give on the exit side is, if you know, right here at Houston, if you look at ThoughtTrace, which is our AI company founded in the late '80s in the Woodlands, quite seriously, and they were born. The AI was built around basically analyzing land and lease documents. And you kind of fast forward to a year ago when they were acquired, but they ended up with that capability, sort of born and built here in Houston on oil and gas. They ended up being acquired by Thomson Reuters to apply it to a greater scope of contracts.
So when we met in Denver in November, Sean, you gave a very insightful presentation that talked about all the shortages around critical minerals, right? And how difficult it is this was an industry that was already on the decline, pretty rapid decline curve in terms of finding rich ore from which you can extract these minerals, right? And now the demand is doing this and supply is doing that, right? And at the same time, we are seeing companies like Exxon get back into lithium mining and all of this stuff. And then we are seeing a lot of discussion around direct lithium extraction from produced water brines and other saltwater brines and all of that. Is there a play for OFSCs to kind of develop role, technology, opportunity in and around this space?
Particularly with minerals?
Minerals, yeah.
To be determined. We see a lot of upstarts that are wanting to extract out of produced water and so forth. I think more often than not, there's not enough concentration for that to be economic. But the answer is yes. But I think what we're going to see, the problem is so large, though. I think just completely, jumping out of oil and gas. I think you're going to have to see a huge wave of innovation just in core mining technology. Because I think to the extent the oil and gas or the OFSC industry gets involved with it, I think it's going to be de minimis relative to the scale of the challenge.
Are you seeing any of the OFSCs get into this space? Or?
Yeah, a little bit. I would say, I think to Sean's point, look, they know the composition of the water better than just about anybody. You need it at a massive volume unless the filtration system is going to work better and faster and get you the quantities that'll be economic. We've looked at it very high level. We've looked into it for a few of our customers, particularly those that touch a really high volume of water, whether it's through recycling pipelines, SWDs, trucking, et cetera. And you need a huge concentration of volume. And I don't know, I liken it to kind of when there was a big wave, I feel like 7, 8, 9, 10 years ago around water recycling and doing it with mobile packages. My understanding was, you could get a trial with Chevron in West Texas, and they could never really get it lower than $3.50 or $4 a barrel to put it through that process, because you just needed so much scale and volume to be able to make that equation work. So now you see water recycling from like the Selects of the world, and it works, but you got to get the volume, and it helps if you have this interconnected network where you can arb the water, right, and kind of arb the waste in the water, if you will. But so far we've seen a lot of press releases. We haven't seen any like huge swaths of capital or any like what I would call commercial genuine breakthroughs come through. And then I think as far as service and equipment companies think about mining or extracting minerals, we have an entire like world of mining contractors that do that. And there are some principles that are applicable, but that world is so well capitalized and has been around for so long. I think it would be really hard. Like, you've seen a Weir step into services and equipment, but I can't think of a service and equipment company that stepped out with like $1 billion mining style acquisition. And I think it's because you're starting to play in that general industrial world, and you're just talking about completely different balance sheets, capital raising, capital equipment cycles, labor force, union issues. I mean, it's just the supply chain's different. So I'm not saying never, but I think there are a lot of reasons why we haven't seen service and equipment companies try to go that route.
Just staying on this theme on new technology, new breakthrough technology, right? Like small modular nuclear reactors, right? People have been talking about applications in offshore platforms. Even, we did some work where we kind of looked at it from large well pads in the Permian, for example. Are you picking up any chatter, any interest, any thoughts around that?
I mean, the promise is always there. I just think there's such a visceral reaction to nuclear, as pragmatic as it can be. I mean, you look at the U.S. Navy and how many small modular nuclear reactors they've managed over decades, and zero incidents. I mean, how many people have died from a SMR in the Navy? Zero. So I just think there's just so much societal resistance to it, despite the rationale.
I mean, I 100% agree. Like, I don't know, on Earth Day, if they made everybody study Hyman Rickover and what he did for the U.S. Navy, maybe people would feel differently about it, but they don't. And so I think, look, really intelligent, thoughtful people think that that's the answer. I mean, you've started to see, I think it was Sweden that said, we've got to abandon this, like, renewable strategy, and that's going to get us to net zero, and we've got to pivot very heavily to nuclear. Yeah. Like, that's the only real viable option for us as a country. I think we're going to start to see more of that, but to me that was really, really telling, right? That was an admission that, like, physics works, right? And so I think we're going to see more of that, but it also makes me an even bigger believer in natural gas. Mm-hmm. Yes. Because the infrastructure's there, people understand it. They know that the U.S., whether they want to admit it or not, is the only country that has been in accordance with the Paris Agreement because of coal to gas switching, and that's despite the fact that the Trump administration left the agreement, and we still were the only first world country in compliance with it. Yes. Like, natural gas is a really, really great, ubiquitous answer for everyone. And there's not the same resistance to natural gas that there is to nuclear. So I think it's easy for me to tell a societal kind of psychological story around why that'll be a bridge fuel, besides the economics and the use cases for it, which are worldwide.
Yeah. So, Sean, you brought up Seek a little bit, right? My understanding is that a lot of Seek's applications are in the downstream part of the oil and gas value chain. Is that correct? And second, if not, I guess what are some interesting cases? And maybe give us a little bit of an intro to what Seek is, because I think the audience would be interested in knowing about that.
Yeah, Seek is really emerged to be the world leader in time series data analytics. They even have patent portfolio around how they do that. When we first met with the CTO, when he's talking about time series data and why it's so difficult to analyze, the other piece that he added was the other time series in that subject matter expert's head. And that's what they really enables. And they enable that smart user to extract insights out of their data that they couldn't historically. Like many of our portfolio companies, definitely a center of gravity in oil and gas. They cut across basically every industrial sector, basically anywhere there's a sensor collecting data. And yes, within oil and gas, they're very much, much more of their sort of user base is in the sort of, downstream, midstream. But I think very uniquely, if you look at what Devon was able to do with their offset well pressure monitoring, a lot of the insights that were derived from the data were from a very smart Kyle Hospeed over at Devon using Seek to basically, crack that code and make those insights that then they sort of turned into, it actually productized into a product. I think it was, cover of JPT, a year or so back, but that was a very novel way to use Seek within the upstream sector.
So, Austin, any interesting companies from a technology point of view or from a business model point of view in the OFSC space that we haven't heard of from your point of view?
Well, I mean, I got all kinds of baseball cards. Like, just, see me later and sign an NDA. I will, in all seriousness, one of the themes we didn't touch on was water. We did kind of tangentially related to this lithium extraction. We're working with what I'll call a water management company right now. And what's fascinating to me is, you used to have a linear equation moving water around the oil field, right? You went from aquifer to pit to downhole to SWD. It's like really, really straightforward. And maybe you mixed it with a couple of clean barrels and then put it back down. But linear, right? Mm-hmm. A lot of people can do that, and it's a simple equation, right? Like, we could do that in like 5th grade-ish, some of us. But now that you have water recycling and you have all these alternate uses and you have seismicity issues, which are more and more prevalent in southeast New Mexico and really in West Texas too. It's Texas, so it'll take us a second. But also this idea that you need to know the composition of your water because you need to know that marginal economics to put it through the recycling facility or put it back downhole, or how much you can mix it with at a pad at capacity to put it back downhole. Those are really interesting, very complex equations because of all the variables, and you need it in real time, right? And you need to do it 24/7. So if you can do that in the oil field, you can do that in municipal water. And you don't need any different equipment, and you don't need any different people other than a sales individual that knows those relationships. So when we're talking about things outside the oil field, I think what's drawing a lot of interest in our world from some of those generalists too is, show me something that's working in the oil field today that I don't really have to change. I just need to hire a business development group. And in 5 years, 30% of my business can be automation, or 35% of my business can be municipal water, because those businesses trade. You're just arbing a multiple with the same skill set, same equipment, same investment profile. Right? So you're not changing free cash conversion, you're not changing how much capital the company needs. You're just applying the same first principles to a different end market with a higher value. We have things like that. I've got some businesses that utilize natural gas to go power production, which I mean, that's just huge. We're in the early innings of diesel to gas switching. Everybody understands the diesel to gas arb. And it's cleaner and greener, like as a tertiary benefit. And then we kind of have everything in between: production chems, more artificial lift, more accessories. I mean, I think we have about a 50% market share in deals in oilfield service and equipment. So inevitably, we have something that fits something.
Yeah, sure. Let me open this up for questions from the floor, see if anybody has questions.
We covered it all, man.
Good job, man.
Well, I mean, if I do have a couple more questions, so maybe we can go through them. I guess in terms of the policy environment in and around natural gas, it's a slightly interesting environment right now. I guess what does that, how are OFSCs reacting to, for example, this pause on permitting new LNG exports to non-FTA countries and all of that stuff?
Yeah, like publicly, I think they're going to, in a very professional way, state the case why this is bad for the world from a lot of perspectives. I think it's interesting to me that in an election year you would do what would cause our feedstock costs to be the lowest. I think from a political standpoint, it's an absolutely brilliant strategy, because you saw natural gas dip below 2, and we know natural gas is a huge feedstock for petchem, which we've re-onshored in a large way, particularly post the kind of nuclear winter in Germany and Nord Stream and all that, right? We're all familiar with that. Do I think that's a viable long-term strategy? I mean, I don't.
But do you think that because of that, the implication is that there'll be greater scrutiny of, say, methane emissions across the value chain that could support some of the technology development in the space?
I think it depends on who gets elected, honestly. Like if we have a similar group that's there today, I think the regulatory screws get tightened even more and more on things like that. I think if we have the opposite, the alternative, then I think we wind up with a lot of regulations being rolled back, similar to what we saw in the election cycle when Trump first came in, right? You just saw regulations just completely get torn up and thrown out. I will say this, I do think net for the world, like, it's bad for us not to export as much LNG as we can. Like, it really does impact people in developing worlds, like, disproportionately, that don't have access to cleaner burning fuel, that need it, and they need it like now. And so, thank God that we didn't have a worse winter last year or this year, like globally. But these are like real issues, and I completely agree with Toby Rice. Like, we can solve them. The U.S. alone can solve these issues.
So Uday, will you take a follow-up question on this? Sorry.
Yeah, sorry, Esben, I didn't see you. Yeah, please.
No, I was a little bit late. I liked your question. I would like to follow up on it. So could you gentlemen elaborate on how large are the fugitive emissions? So, I mean, for each million standard cubic feet of natural gas we utilize downstream, how much are the emissions today, would you say?
Yeah, I don't have that number handy at all.
I don't know.
No.
I don't know.
So, because the reason why I'm asking is because there's been this discussion between blue and green, and in blue processes you can probably capture about 95% of the CO2 emissions. But then there was an American professor who made some calculations, and he said, well, then there will be a higher energy consumption, and we have so much fugitive natural gas emissions, and they have a much worse greenhouse gas footprint, that it more or less compensates for the savings. So I mean, if you get 95% recovery of CO2 downstream, but you utilize maybe 20% more natural gas for the same end result, then you're back to square one.
Yeah, well, if we're gonna bring 3 to 4 billion people out of poverty,
right.
I mean, like, huge news flash, we're gonna burn way more CO2. And I think the question we have to ask, like, morally, globally, is like, do we wanna leave all of those people in poverty, or do we not? Because the tools that we have in hand today, that we know work, that we have infrastructure for, that we have the ability to provide, right? Those are hydrocarbon-based fuel sources, and that's what we have access to, and that's what we have today. And I think, to me, in a pragmatically perfect world, we would enable those groups to use the cleanest burning and the cheapest and the most efficient, from a physics perspective, excluding nuclear, source of fuel, so that they can come out of poverty too, because energy input is so critical to your ultimate GDP and what your economic capabilities are as a nation, to utilize those. And then in the meantime, we're coming out with these new technologies that are viable and that work, and that ultimately, right, take us into the next few centuries. But I don't think that we can sit here and tell those people, glad we got all the benefits of hydrocarbons, sorry, you got to use the really expensive stuff that's not ready yet, and it's going to cost trillions and trillions of dollars for you to get there, even though you don't even have clean running water yet.
It's the hubris of the West.
Come on, really? That's what we're going to say to people in India? Like, that's not fair.
Yeah,
we're in Africa.
We invented the game of the Industrial Revolution. We won it, and now we're declaring game over.
So
that's not going to fly.
This is a good place to segue into our next panel, which is on gas and LNG.
There you go.
But thank you very much.
And
I much appreciate.
And freedom.
I much appreciate both of you guys. I told you these are characters, and this will be a good panel. Thank you very much. Really appreciate.
Thank you.
Thank y'all.